Good evening and welcome to another exciting episode of Bond Squad After Hours. I'm your host, Tom Byrne. As always, Bond Squad After Hours is brought to you by WS&M LLC, Wealth Strategies and Management, and Bond Squad. WS&M and Bond Squad are separate entities from Private Advisor Group, PAG, which is a registered investment advisor and our registered investment advisor and a great bunch of people. We let off with sweet emotion because today's news, both economic and political, have driven a lot of emotion today among market participants, investors, and they're not the same thing, and just the average citizen. So what we want to do, let's fill you in some breaking news. About 20 minutes or so ago, the Greek Parliament approved the bailout plan, which pretty much condemns Greece to no growth for the foreseeable future. They would have been better off, following through on stuff years ago. They might have been out of it already. This is going to grind the economy to basically a halt. It's going to leave Greece, with two choices: either reform the economy more along the lines of Germany eventually, or get out of the EMU. We think it'll eventually be the latter. Could take a year, 2, 3, but Greece will be gone. Now the ECB has to try to come up with a plan to recapitalize the banks because the Greek banks are out of money. There may be bridge loans. How much risk does the ECB take? Because there's always the possibility that the Greek government reneges, probably silently, just doesn't do what they're supposed to do, but reneges on the bailout agreement. It's not like they haven't done that before. So we're back here in Greece. The bond market so far in overnight trading, which has just begun for U.S. Treasuries, likes it. We saw the 10-year Treasury close at a 235 in U.S. trading. Overseas now it's up to 237. So yes, Greece not leaving the euro, I guess, is somewhat inflationary. Now that brings us to Ms. Janet Yellen. Ms. Yellen is a fellow former Brooklynite, like Bond Squad. In fact, she and I actually attended one of the same schools there. I'm not going to date myself, but we were not classmates. So let's leave it at that. But Ms. Yellen had the pleasure, and we use that word very facetiously, of testifying before the House Finance Committee. Tomorrow she gets to testify before the Senate Banking Committee. So I'm sure Ms. Yellen is loving the today and tomorrow. But there's nothing really that new in what she said. The Fed expects the economy to grow faster, although way down from their original projections for 2015 they made last year before that. And she also said that Fed tightening is predicated on the economic data meeting the Fed's goals. That might happen, but we think the Fed's going to lower its goals. She sees the economy building strength. Bond Squad sees the economy as a 2.5% economy. That's probably what we're going to print for Q2 with no makeup from Q1. Maybe you see 3.5 if there's some inventory built for the holidays in Q3, and right back into the twos when you take that with a negative 0.2%. And Q1, we're going to be somewhere in the low to mid twos, in all likelihood. So, that's probably where we are. You can't say it's if it wasn't for exogenous events, if it wasn't for overseas, if it wasn't for weather, it wasn't for the Japanese earthquake a few years ago, if it wasn't for whatever, there's always something. The economy and markets don't exist in the vacuum. They never have, they never will. And it was that the U.S. economy was structured that it could grow 3, regardless of what was happening overseas or even internally as far as exogenous or weather events and whatnot. Some of it can be blamed on fiscal policy, but most of it's due to demographics, right? So this brings us to an interesting comment, well, an interesting exchange Ms. Yellen had, and I cannot remember the congressman that she had this exchange with, but it was along the lines that this congressman wanted to push the Fed into a rules-based policy mode. So where economic data, it could be whether it's inflation or employment, whatever, hits a certain number, the Fed has to act in a certain way with policy without taking into the context, using almost the Taylor rule. When we're here on inflation and unemployment rate, the Fed should do this without considering the rest of it. So Ms. Yellen fires back and points out correctly that no central bank does that central banks need the flexibility to assess what's going on and why these numbers are the way they are. For instance, you could have inflation due to a weaker dollar. You could have inflation due to stronger consumption. They both result in inflation, but one is a strong economy. One might be because of a weak economy. Okay, maybe the Fed has to tighten in both instances, but maybe it has to approach things somewhat differently, right? So there's this idea, and it's in economics, it's in the political circles. Some people think they understand economics. It's in the wealth management industry that everything has to be broken down to a model. When the rates are here and this and CPIs there and whatever, investment portfolio should look like this, And we're segueing now, so just try to keep up. But another congressman today said, he actually quoted Einstein, and I cannot remember this congressman's name either, but he said he was a physicist. So somebody can look that up, which congressman is a physicist, right? And this physicist quoted Albert Einstein, and this is one of my favorite Einstein quotes. It says, "Everything should be made as simple as possible, but not simpler." Now think about that. That Mr. Einstein or Dr. Einstein was not saying that everything should be made exceedingly simple, but as simple as possible. And we take that to mean as simple as feasible, as practical, as it is intelligent. So we can't just take a number and build a model to every time this data hits this, the model does that. Be it the Fed's model, moving interest rates, be it an investment model, doing asset allocation. Now, we segue into asset allocation here because there was a very good article that was published over last weekend by Barron's about bonds versus bond funds. And in the last 10 years, investors and even more so investment advisors have blurred the lines in their own minds between bonds and bond funds. We speak with a lot of advisors, we do branch visits, and it seems like advisors, especially those who, let's say, have 10 years or less in the business, believe that bond funds or ETFs are like buying a bond ladder. But they're not. They're not anything of the sort. And when we go, there was a great quote in the article by an asset manager, and we just lost our place. So give us a second to get back. Where we go here? Basically, the quote was by an asset manager saying that with a bond fund or an ETF, you don't have a maturity. You're essentially buying stocks. And you are, and we've written this many times. What you are doing when you buy a bond ETF or a bond fund is you're buying shares in an investment company that's taking position in or taking a speculation or stating an opinion in certain areas of the bond market. They're not trying to, and here's the quote. It's by Ron Weiner, CEO of RDM Financial in his offices in Connecticut and Florida. And he says here, if you have a bond fund or ETF, you don't have any maturity. That's not a bond, that's a stock. and he finishes, there's real risk in bond funds. So remember, a bond can be held to maturity. Okay? It doesn't matter what it does in the meantime. I can have a 10-year bond, and the 10-year treasury can rise 100 basis points, and I lose 8% on that bond if I sell it. But if I hold it to maturity and the bond matures and the issuer is solvent, I lose nothing. NOTHING, nothing. And the way to get around this is by barbelling or laddering. If you have a barbell or a ladder, part of your portfolio is at the longer end of the curve and it's taking advantage of higher rates now, and the shorter end lets you to reinvest on the way up if rates do in fact rise. You have to take an ownership stake. The problem is everybody is focused on modern portfolio theory, as if modern portfolio theory, or MPT, is designed to solve all problems, because when certain market signals or economic signals appear, the model rebalances the account, and you put in your clients or your own parameters, and it gives you the right amount of stock and bond exposure, except for one thing. It gives you zero bond exposure. It gives you bond fund exposure. So what is MPT designed to do? Here's what it is, guys. Every MPT portfolio has one objective. It can arrive at it very different ways, or somewhat different ways, but has one objective: total return with a hedge. It's a hedging total return strategy. That's why you have some exposure to bond funds and to stock funds, and it changes. You want the inverse correlation, of some kind. Problem is, if you're a boomer, right, and you're turning 65, and you have this 401k you need to roll over, and your Social Security or your income, right? What do you need? I need to know how much I'm getting each month. I need to know what these things are worth on a given day down the road. I need to preserve my capital and generate reliable, predictable income, at least with a portion of the portfolio. MPT cannot do that on its own. You can use an MPT strategy for the total return part of your portfolio, but if your portfolio or your client's portfolio is completely in a model, some called UMA models or whatever, if it's completely in a model, you are not managing that account properly, unless the goal is total return and only total return. And it's ridiculous. Model portfolio theories. So some of the models say, oh, if you're 55 years old, you should have 60% in bonds. Really? Just because you're 55? What's your net worth? What's your goals and objectives? What's your risk tolerance? What other sources of income do you have? It's insane. It is unwise. It is foolish to go by a blind model. A model should be part of your investment strategy, but it should not be your investment strategy. That's as ludicrous as the Fed saying, well, every time the unemployment rate gets to 5 and every time inflation gets to 2, we're going to jack rates 50 basis points a meeting until that goes away. Okay. What if you have an unemployment rate that's sitting, like we have today, in the mid 5s, but a lot of it is because the labor force shrunk? That if you took that into account, your unemployment rate is probably closer to 10, right? Well, obviously the Fed today, even though we believe at Bond Squad that the Fed should have tightened before, right? If it tightened aggressively now, as if it was a real 5% unemployment rate, you would sink this economy. So the Fed has to take that into account. Why are we at a 5.5 or 5.3 or 5 flat unemployment rate? And then go from there. All right. You have to do that when you're building an investment portfolio. Sorry, guys. MPT, if you're using MPT totally, one, you're not adding value for your clients. Sorry, that's our opinion at Bond Squad. But also you've made things simpler. You made it simpler than as simple as possible or as simple as feasible. You've dumbed it down to the point that it's too simplistic. Okay, it's too simplistic. Yes, the models are complicated, but models are backward looking. We had this discussion in our office. We had a great representative from First Trust, somebody that we actually like a lot and gives a lot of good information, in the office today for a lunch meeting. And he had a great way of looking at models and building models and reviewing models, but everything was backward looking. Well, the models have to be backward looking because they take past occurrences and try to bring them forward as possibilities, right? So back testing is great, but it's not the end all and be all. It's like driving your rearview mirror. You know where you've been and you know what might lie ahead, but you better look out that windshield or you're gonna smack a tree. And that's what happens. Case in point, everybody was saying, the MPT folks, buy junk. They're saying buy tips. And by the way, tips have tanked since April. And we were warning on that, but, the model guys knew better, not the bond guys. So, but going forward, the mantra out there was to look at junk bonds as a way to outperform when rates rise. So we did a little homework, and we compared March 15th. That's the day that everything really started pushing up. It crept up before. That's when things really started rising as far as rates go. And we found that since March 15th, the 10-year U.S. Treasury note is up about 25 basis points as from today's close, 211 to 236, right? And we looked at A-rated corporates. So they're up about 42 basis points on average. And we looked at AA-rated muni GOs. Well, they're only up about 20-odd basis points. So they've actually didn't sell off as much as treasuries. And every expert out there on the models are saying, oh, you don't want municipals. A lot of trouble with municipals. You want junk. Yeah, junk bonds have blown out on average over 70 basis points. That means they sold off 50 basis points more than the 10, or I'm sorry, I think they're about 45 basis points, well, between 45 and 50 basis points, more than the 10-year Treasury. Well, that's a big difference because a 50 basis point move on a 10-year bond, especially with a lower coupon that you see today, is going to be about 7.5% more of a decline than the Treasury did. So your junk bond just got whacked. That's for B-rated. All right. Now we had today, this afternoon on the CNBC Seeking Alpha conference, we had Larry Fink and Carl Icahn arguing junk bonds. Larry Fink does not think there's a big bubble in it. Carl Icahn does. We agree more with Carl Icahn in that the triple C area and lower and double C, they're overvalued. And good Bloomberg story out. I believe it was Bloomberg story. It might have been Barron's actually. I got to check this, but came out that junk bond covenants are the weakest they've ever been on a scale of 1 to 5. 5 being the weakest, they're like 4.5. On junk bonds and loans. So yeah, keep buying your loans. They're fine. You have very little protection on those. But where we disagree with Carl Icahn, we don't think it's a 2007 event. We don't think it's that bad. And we think that most of the risk is in the lower parts of junk bonds, which is why we've been okay. We're client suitable, okay, in double B and even some single B names, but we choose them. We don't just say, oh, junk, we can buy it. And where Larry Fink was wrong, he said it's not a big deal because mom and pops really don't own junk. It's mostly institutions. Not anymore. We've seen the sales pitches from wholesalers, from model portfolio departments. They were advocating junk for mom and pops by way of the worst thing in the world, junk funds and ETFs with no maturities, no nothing. You can't select your credits. Well, we hear all the time, it's too hard to select your credits. You have to do credit research and read reports. Yep, you do. You absolutely do. There are no shortcuts in this. If you're a client and you can't do it, that's understandable. Go find yourself an advisor who can or has somebody on their team who has resources they can do it. What you don't want is to just farm it out to a manager, especially a fund or an ETF, and say, yeah, whatever happens, he's the expert. You don't want to do that. Even the portfolios that Bond Squad runs, we are always talking to advisors on this. And we've even had meetings with advisors with the client present or conferenced in. The client needs to know what's going on and why he owns what he owns and what the real risk is, and so does the advisor. Okay? Suitability trumps everything and anything out there. But it doesn't seem to matter in today's world, right? Just stick it in a model. And now politicians are trying to do that to the Fed. Get a model. We don't want the Fed just, flying by the seat of their pants. Yeah, you do. Because the flying seat of their pants, you're looking out the window. You're looking out to see what's ahead, so you don't smack the side of a mountain while you're flying, or hit another plane. You can't make things too simple. Einstein was right. Right? Imagine that. Einstein was right. Okay? And this is the problem in the bond market right now, or in investing, in fixed income investing. We've dumbed it down too far. And we saw something interesting happen today. Again, the model guys out there saying, when the Fed raises rates, watch those long-term rates go. They're going to go sky high. Just as they said when the Fed did QE1 and QE2, that those long-term rates were going to go down. And the exact opposite happened. Well, the exact opposite's happening now. Ms. Yellen comes out today, gives a little bit more upbeat on the outlook on the economy than we think it deserves, but says we're probably going to tighten this year. And what happened with long-term rates? Whoosh. They came down 5 basis points. Well, what's going on? The Fed says it's planning on tightening, and the long end comes down. Again, bond market 101, when the Fed tightens, it's anti-inflationary. Thus, it starts creating headward or downward pressure on long-term rates, at least buffers their rise or even pushes them down. You get a flatter yield curve. And that's what's been happening. And if you watch and listen to the bank earnings reports, you've seen that almost every one of them have said that net interest rate margins have either remained static, haven't improved, or they've flattened. And that weighs on their profitability. Remember, a bank makes money in general with lending by acquiring money at lower rates on the short end and lending at higher rates on the long end, right? So I borrow money in the commercial paper market, in the repo market. I pay a low interest rate on savings accounts, and I take that money and I lend it out for a 30-year mortgage at 200 plus the 200 basis points over the 10-year treasury note, right? So I borrow here and I lend here. Well, as those rates become similar, my profit declines and my incentive to lend decreases. And if I'm making less money on each loan, what do I want to do? I want to make sure those loans are paying. So I increase the criteria, the credit quality criteria of each borrower. And Ms. Yellen noted that too. She thinks that's holding back housing a bit because credit conditions are tight, or at least tighter than what we've become accustomed to. And that net interest margin does that. So now Ms. Yellen has to tighten, which could flatten the curve and it could crimp the housing recovery. Then she has to worry about the stronger dollar. Our rates rising while everybody else is in full ease mode makes the dollar more attractive because unlike what they teach investors and advisors, through sales literature, that's what it really is. It's not really research or strategy for the most part, right? When rates rise, it attracts capital. It may repel mom and pop because they think about it in a backwards way, but it attracts capital from overseas. If I can go get a higher interest rate in the U.S., remember, this is sticky money. This is bond money. It's not going to equities, right? In any case, so then if I'm overseas and I can get a higher yield in the U.S. versus other developed countries, and I have the currency appreciating, the U.S. denominated, dollar denominated bonds are a pretty good bet, right? So what happens is the money floods in and it starts holding down those rates. This isn't rocket science. It is basic bond market. All right. And very few people seem to get that. It is really, really not that difficult, but it seems to be, a topic that's lost on most people. We really don't get it here, but that's what it is. So, we look at the banks. The bank earnings were just okay. We don't see long-term rates spiking. Jeff Gunlock at Double Line sees something. He thinks the 10-year could finish the year or visit before the year end in the low twos again. That's possible. We still think it ends somewhere around here, 240-ish, 235, 245. But who knows? If we're wrong, it's probably because he's right, not because rates took off. Right? He's a bond guy. He understands what he's talking about. He also moved money in his funds and remember, his funds aren't for income. They're necessarily. They're trying to play the bond market. They're speculating a bit. He moved money into what? High grade, investment grade back in May. Now he's dipping a little bit into junk because junk spreads are blowing out. I just said it. 70 basis points that moved versus 25 for the Treasury, or 75 versus 20. So 50 basis points wider versus your Treasury benchmarks. And he's looking at the higher end. Well, we look at the higher end. This is very, very simple stuff, but the business is being dumbed down. And I'll tell you what, folks, the amount of investors is in raw numbers and percentage in the investor population that need income and preservation of capital is going to grow the next 20 years. Boomers are going to do it. And they're going to have to make this nest egg stretch, not for 10 years like their parents, but for maybe 25 years. And what used to kill you now is just a chronic condition, but it eats money, right? The cancer is not going to kill you at 70. You'll live to 85, but your medical bills will be huge, and you can't work. You can't say, oh, yeah, well, I'm going to die at 85 instead of 70, so I'll go out and get a job. No. You still have the illness, and it's chronic. It's still debilitating. It's just not deadly, right? So income investing is going to be huge. There's so much money on the sidelines that's ready to come into the bond market or poised to come into the bond market. It is insane at this point. The amount of inflows that we could see in the not too distant future. What do we think? Oh, the charts. We published charts. It's up on our website, and we added it to the main page of this broadcast, showing we have one chart that shows the U.S. Treasuries March end now rather, with single A and single B corporates, and then a separate chart just to make it a little cleaner, showing double A muni GOs. And you'll see, you can if you go on the website, www.bond-squad.com, go up there, click on the left side, scroll down where it has the yield curves and charts, and right there you'll see the charts I'm talking about. This is not our opinion, guys. It is actual data. So last thing before we go, we want to discuss the economy just a little bit. We've seen data start to come in that, we've been of the opinion for like the last month or two that we're shifting into the late cycle. Most experts, and most from the equity side, keep saying, oh, we're in mid-cycle. We don't see it. And we're seeing the trends that are going to late cycle, slowing of hiring, not stopping, but a slowing in the expansion of hiring. We've seen retail sales slacking off. We've seen industrial production. Even our best number is lower than the lowest number last year outside of Q1 last year. So now we saw the NFIB small business optimism with hiring plan scale back, wage growth plan scale back, CapEx plan scale back. This is feeling very late cycle. We thought we're in the seventh inning stretch, ready to start the bottom of the seventh. We could be in the eighth at this point. We still think the mid seventh is probably right. That means you might have this year and next. But we're getting near the end of the cycle. Now, here's something that we're going to contest. We'll contest from Ms. Yellen. Her opinion is that the longer the Fed waits to tighten, the more aggressive it has to tighten. In other words, the Fed thinks it's going to fall behind the curve, not the yield curve, but behind the curve as far as keeping pace with growth. That it might keep rates too low, too long, and then growth and inflation, especially inflation. Remember, that's what bond yields really adjust to, take off, and the Fed has to play catch up and has to go more dramatically. We don't think that's her problem. Bond Squad thinks her problem is that she waits too long. She'll be tightening when the economy is already in its downward cycle. It's at the end of its cycle, going into the recession cycle. The Fed needs to tighten now just to have some ammunition for when we get to that recession. And the fact that she's considering tightening, I think it was Jeff Gundlach said, if you came down from Mars, if you were off the planet for 10 years, you came down from Mars, and you saw our economic data, our job growth data, our GDP data, and all the economic data, and your first question might be, if you're in this business, was, when's the Fed going to ease? But the Fed has to tighten now. Okay, so The Fed needs to tighten before it's too late, in the economic cycle. So we think the Fed goes a quarter point, still base case September, possibly December, although the Fed doesn't like to tighten in December. That's why we're still airing to September. But you know what? We've probably seen most of the rate rise that we're going to see. And, start building your bond portfolios, build your ladders, build your barbells. We're here to help. If you're a subscriber, we can review, even put together a sample ladder. If you want us to manage your portfolio, we can do that. We have Bond Squad Income Solutions. We will manage your portfolio for you, not a prefab model, not a prefab portfolio. We will build one for you. And you know what? We're talking pretty low fees, probably less than the fees that you're paying either upfront or buried in your mutual funds. So you can call us at 570-424-1555. My email is thomas.byrne, B-Y-R-N-E, at WS, the word and, M as in Mike.com. Check out our website. Click on the Bond Squad Income Solutions tab. Our website is www.bond-squad.com. Follow us on Twitter at @bond_squad is us. We're in touch with everybody. You'll be surprised to see who follows us and who we follow and who we communicate with. But go up there. We're more influential than you think. That's all we have for tonight. Today is my mother's 83rd birthday, 83 years young, doing great. Just saw her before the broadcast. Happy birthday, Mom. And with that, we'll say goodnight to everyone. And remember, buy bonds, not bond alternatives. Thank you, and have a wonderful, wonderful night and a great week ahead. And happy summer. Good night.